Investing in stocks is how you build your wealth, right? The US stock market has been one of the greatest wealth creation engines in human history. It's created $91 trillion in wealth over just the last 100 years. Picking the right stocks is supposedly how you do it, but almost nobody wins that game. Over the last 15 years, more than 90% of the actively managed funds underperform the S&P 500. And the average retail investor has underperformed the S&P for 15 straight years. So, how hard is stock picking really? A finance professor at Arizona State decided to find out using 100 years of data. He looked at every common stock ever listed on a US exchange, going back to 1926. That is 29,000 stocks. Average return across all of them, over 30,000. But the median, or the most typical result, negative 7%. More than half of all stocks ever listed lost money, and only 27% beat the market. So, if most stocks lost money, where did $91 trillion come from? From just 46 companies. Out of 29,000, these 46 account for half of all the wealth created in the US stock market. The top 1,000 firms, or about 3.7%, account for all of it. The other 96% of companies combined produce zero net wealth over a basic treasury bill. The reason is actually quite simple. When you invest in a stock, the most you can lose is 100%, but the upside is unlimited. Nvidia has returned over 500,000% since its IPO. This asymmetry means that a handful of extreme winners can get your average way up, while the typical stock goes nowhere. Just a few stocks do all of the work. And here is what you should really take away about your investing. The number of stocks that carry the market has been shrinking. From 1926 to 2016, 89 companies accounted for half of the market's wealth creation. The last 9 years, that number has dropped to 46. From 2016, the top 30 companies captured 61% of all the wealth created. But before you say, well, I own one of the winners, you don't own all of the winners, and the winners are changing constantly. Through 2016, these were the greatest wealth creators in American history. 19 of the top 30 from the last decade weren't even on the list before it. General Motors is on the all-time list despite going bankrupt in 2009. Decades of dividends earned its spot before the stock went to zero. The winners rotate constantly, and it's hard to predict who is next. This is why investing in an index works. You don't try to pick the 46, you just own everything and let the winners find you. The paper's conclusion wasn't that stock investing is foolhardy. It was that the market success is driven by a tiny number of companies, and that number is shrinking. The practical takeaway is simple. Diversification isn't just a hedge against bad outcomes, it is how you make sure you hold the few winners and let them do their thing. You don't have to pick the 46, you just have to own them. Learn more at usecash.com.